Okay. So our chapter is cost, volume, profit analysis, or CVP analysis, right? And we've covered a lot. We learned this concept of contribution margin, which is by itself fairly simple, right? You take your sales, subtract your variable costs, and you get your contribution margin, right? And we know it comes in three different varieties, which are not there. Okay. One would be the per unit contribution margin, where you just take the sales price per unit, subtract the variable cost per unit, and you get your contribution margin per unit, right? And so it's really the same formula that we see here. Total sales minus total variable cost equals contribution margin. And you can just put per unit in front of everything, and same formula works. Then we went through some examples. We don't have to get through all that. We do see here the third variety, the contribution margin ratio. And here you take your contribution margin per unit and you divide it by your sales price per unit. What was an alternative way you could calculate your contribution margin ratio? Exactly. Just take the contribution margin, divide it by sales, and you get the same ratio. Who remembers how we can use this? When does this come in handy, this ratio? Remember how if you want to figure out what your break even is in dollars, you can take your fixed costs, divide by your contribution margin ratio, and that answers the question for you. All right. So a lot of this were just examples. We really don't need to go back over. We did learn that the break-even point is where sales equal total costs. At that point, you don't have a profit, you don't have a loss, right? You earned enough in sales to cover your fixed and your variable costs, your total costs. And so you've broken even. And I told you there's another way we can express the break-even point that's different. What was that alternative expression of the break-even point? That's right. Thank you, Aaliyah. When your fixed costs equal your contribution margin, that is also your break-even point. Very good. We looked at some visual examples. So hopefully that was helpful. So if we want to figure out how many units we have to sell to break even, we take our total fixed costs, divide by our contribution margin per unit, because every unit we sell is contributing towards covering our fixed costs, right? So once we've sold enough units, we've broken even. We take the fixed costs, divide by that contribution margin per unit, and that tells us how many units we have to sell to reach that point. Now, as I mentioned, we can figure out break-even point in dollars using the contribution margin ratio, but I also told you there's another way that's easier. So if we know we need 225 units to break even, how could we figure out what that is in sales revenue? Would be a shortcut.
Is it total units minus your break-even point units?
No. So we know the number of units we need to sell, but how do we convert that into how much revenue we need to earn?
Multiply by the cost.
Yes, so we multiply the number of units to break even by the sales price per unit, and that gives us the revenue to break even, right? Okay. So more and more examples we can skip past. So again, this would be the other way to calculate your break even in dollars. You would take your fixed costs, divide by your contribution margin ratio. So here we have fixed costs of 18,000, contribution margin ratio of 0.8, and that tells us the total revenue we need to earn in order to break even. Here we see 5 of these formulas. I don't think I need to elaborate on that. Okay, more examples. Oh yeah, target profit. All we need to do when we have a target profit is just add that amount to your fixed costs. And the rest of your calculations are the same, right? So if you're trying to reach a certain target or desired profit, add that amount to your fixed costs, and then divide it by your contribution margin per unit to know how many units you need to sell to reach that point, right? Or divide fixed costs plus desired profit by your contribution margin ratio, and you know how many dollars of revenue you need to earn in order to reach that level of desired profit. That's not really too hard. This takes it a step further. If you're given an after-tax profit, you have to first convert that into a pre-tax profit so you can then use these formulas. And the way we do that, just to remind you, whatever that after-tax profit is, divide it by 1 minus the tax rate. I did look it up, and 21% is the corporate tax rate. So that's what most corporations pay in theory. I'm sure they have loopholes still to get around some of those taxes, but that's what they're supposed to pay. So today, for most corporations, it would be 1 minus 0.21. What is 1 minus 0.21?
0.79.
0.79. So you'd be basically dividing your after-tax profit by 0.79, and that gives you your pre-tax profit if you're a corporation. Okay, so let me see, does anyone have questions so far on anything? No? Okay. All right. We did problem number 2, as I recall, and exercise 5. So this is in the vicinity of where we stopped. Yes, that's exactly it. This is where we're going to start. Okay. Great. So part of this chapter is being able to do a sensitivity analysis. I think we did see an exercise like this one. And so we've talked about it a little bit. Sensitivity analysis is where you can change something, either variable costs, fixed costs, price, or volume, or a combination of changes, and see how that impacts your profits. So how sensitive are your profits to those changes? And let's go ahead and look at an example of this. We've got this first column is the current situation for the company, but they're looking at maybe changing the price of their product, the sales price. So if they did that, if they increased their sales price by 50 cents from $3.75 up to $4.25, and their variable costs stay the same, their contribution margin goes up. Also by 50 cents, right? If you raise your price, that's going to raise your contribution margin. If you lower your price, that will lower your contribution margin. And if you were to change variable costs, that's also going to have an impact on your contribution margin. Okay, so with this new contribution margin, you can divide that into your fixed costs. We see that here, taking the fixed costs, dividing it by the new contribution margin. And now we see the new number of units needed to break even. So by raising their price 50 cents, now instead of 1,100 units to break even, they only need to sell 900. That 50-cent change makes a big difference. And then you can convert that into break even in dollars. You see they break even at, what is it, $3,825 instead of $4,125. So this would be helpful to managers if they're trying to decide, should we change the price? Now, this assumes you're still selling the same number of units. Well, when we get down here, they're assuming they're still selling 1,500 units. That might or might not be true. Usually if we raise the price, the number of units we sell is going to go down because some people will say it's too expensive. Maybe they'll switch to a different brand. But if the units sold stays the same, we could then multiply that by the new sales price. See how we've collected more sales because of the higher price. Variable costs stayed the same, right? Because we didn't change variable costs or number of units. And so we end up with a larger contribution margin because of that larger sales revenue. Take out the fixed costs, and we end up with almost double the profits. It goes from $900 to $1,650. So if they really can keep the number of units sold the same and raise the price 50 cents, they almost double their profits. Okay. So it's not super complicated, right? If you had to fill this in yourself, let's say you had this first column and you were told the price is going up 50 cents, but everything else stays the same. You could figure out all the rest of that on your own. Any questions on this analysis? Okay, let's look at another one. Here, let's see, the variable cost is changing. So the sales price is staying the same. How much did the variable cost per unit change? 5 cents. Okay, pretty small change, right? So that reduces the contribution margin per unit, right? Because we take the sales price minus variable cost. So if variable cost goes up, contribution margin per unit goes down, right? Now fixed costs have stayed the same. So when we divide the fixed costs by the new contribution margin per unit, we see the number of units we have to sell to break even goes up, right? We have to sell an extra 25 units. Since it's costing us 5 cents more per unit, it's going to be a little bit harder to break even. We can convert that into dollars. See, it's a higher dollar amount. Then again, down at the bottom, we can figure out our new income statement. So if we're selling the same number of units, we have the same sales revenue, but higher variable costs, right? So a lower contribution margin and lower net income. Okay, everybody following along so far? All right, here we have fixed costs changing. So all this stays the same till we get down to the fixed costs. So then when you figure out how many units, well, we're dealing with a different fixed cost. It's a higher fixed cost. So it's going to take us more units to break even and more sales revenue. And again, down in this section, all of this is going to be the same because we didn't change price, we didn't change variable costs. But when we take out our fixed costs, less profit, right? All right, here we've got two changes. Variable costs have gone down and fixed costs have gone up. Now, this is a common phenomenon because sometimes companies will invest maybe in some new equipment or expand their facilities, and so their fixed costs are going up. And they try to do it so that they become more efficient, and their variable costs, the materials that they're going to need per unit, the labor per unit, might go down. An example, I think we see it in one of the exercises or problems, is a company is putting in self-checkout stations. Let's say it's a grocery store. Well, there's a fixed cost to putting in that hardware and that computer software that can let clients cash out, check themselves out of the grocery store, right? So you have that fixed cost up front. but your variable costs go down because you don't need as much labor. Right? And that's what's happening here. We're seeing higher fixed costs, lower variable costs. So again, sales price is staying the same, variable cost is going down, which makes our contribution margin per unit go up. Fixed costs also went up. So now in this scenario, we end up needing an extra 150 units to break even. And we can see our profits go down pretty significantly from 900 to 575. Is it worth it to do this? Well, that's for management to decide, right? If there's some benefit that we don't see here, maybe it does make sense. But obviously we're taking a hit on profits. So from that angle, maybe not. Okay, here we've got 3 columns, right? The current situation. Here we've got the variable costs going down and fixed costs going up. And here, same changes, but we're adding into that an increased sales price. We have 3 new things going on in that column. Well, again, you can just follow through step by step and see how it all impacts. Let's look at the bottom line. Let's look at the net income for these 3 scenarios. If we are primarily concerned with our profits, which of these 3 scenarios is going to make us most profitable? The current, right? Based on this analysis, maybe we should just stick with what we've got, unless there's some other reason that means we might want to change. But if we didn't do the analysis, we wouldn't know. When you have multiple things changing, especially if they're going in different directions, right? You have variable costs going down, fixed costs going up. It depends how much each one is changing. If the variable costs were going down more and the fixed costs were increasing less, then that might end up actually being more profitable. So you really don't know until you've crunched all the numbers. Right? So this is how sensitivity analysis works. Ties into the overall chapter concept of cost, volume, and profit analysis. Right? We're looking at changes in costs. We haven't seen any changes in volume, but sometimes the number of units sold varies, especially if you're changing your price. That might change how many units you're projecting to sell. So changes in cost, changes in volume, changes in sales price, and changes in the resulting profit. So in general, if your sales price goes up, is it going to be easier or harder to reach break even?
Easier.
Easier, right? Because with the higher sales price, that's increasing your contribution margin. If your variable costs go up, it's going to be harder or easier to reach break even?
Harder.
Harder, right? When costs go up, that means you've got less contribution margin. What about fixed costs? If your fixed costs go up, will it be harder or easier to reach break even?
Harder.
Also harder. Yeah. Because got a higher fixed cost to divide that contribution margin per unit into. Okay, very good. What are we at here? Oh, I remember this one. Okay, so this company produces lawnmower engines for $90 per engine. That's the sales price. Variable cost is $60. So what is the contribution margin per unit? 30, correct. And then it tells us the fixed costs, but they're hidden here, 24,000. Okay. So I think this would be a good one for you all to work on here. Based on what we know, what would be the break even in units and the break even in dollars? right? Fixed cost divided by what? To figure out break even in units.
Contribution margin.
Contribution margin per unit, that's right. Fixed cost divided by contribution margin per unit. And what is our formula to get break even in dollars? Okay, fixed cost divided by contribution margin ratio, or you can take your number of units and multiply it by the sales price. Then we're going to see what happens if the variable cost increased by $5. So then it goes from 60 to 65. What would be your contribution margin per unit in that case? Your variable costs are 25 per unit. Oh, did I just give it away?
Yeah.
Yeah. If your variable costs are 65 per unit, you subtract that from 90, you get 25 per unit would be your new contribution margin per unit. Then what if the selling price goes up by $3? So it's now $93 per unit. Sales price, $65 variable cost. What is the new contribution margin per unit? 93 sales price, 65 variable cost per unit. 28. $28 would be the new contribution margin per unit, right? 93 minus 65. So they're throwing all these curveballs here at us. And then if they sold 1,000 engines at that $93 sales price and $65 variable cost, $28 contribution margin per unit, then what would be their profit? So that's what you need to try to figure out. Any questions? Okay, so go ahead and work on that and let's see what y'all come up with. So what did we get for A? What was the break even in units? 800, okay. So we took the fixed cost of 24,000, divided that by the $30 contribution margin per unit, and got 800 units, right? Okay, and then what is the break even in dollars?
72,000.
How much?
72,000.
72,000. And how'd you get that, Alexandra?
I'll just our break even in units multiplied by the $90 per
Okay.
engine.
800 times $90 each is one way to do it, right? Okay, so everybody got that? Did anyone get anything different? All right, actually, let's see, is this? Okay, and if variable costs increase by $5 per unit, how does that change the break even in units? What's our new break even in units for these?
960.
960? Okay, and so that was the $24,000 fixed costs divided by the $25 contribution margin per unit, right? And then what does that come out to as a total sales volume? Break even.
86,400.
Okay. So we can see these answers here. It is 800 units times $90 gave us 72,000 for A. And then 960 units times $90. Is that what you said, Robert? 86,400? Okay, great. So that's A and B. Any questions on those first two? For C, company thinks they can increase the selling price by $3 per unit without losing sales. How many units would they then need to sell to break even? Mhm.
Is that one with the increased variable cost?
Yes, it is.
828.
What's that?
So it'd be,
So it's $28
Yeah.
contribution margin per unit.
so that would be 857.14 units or 858.
Okay. Yeah, 857.14. I would round up to 858. But either one is fine. Okay. And then if they sell 1,000 units, how much profit are they going to generate? Did anybody get that far? This is based on $93 sales price and $65 variable cost. You got it?
28,000.
28,000?
Yeah.
Okay. Anyone else get an answer?
We got 4,000.
So it's 28,000 contribution margin, take out the fixed costs, and we get a $4,000 net income. So 1,000 units sold at $93 gives us our total sales volume. 1,000 units times our variable cost per unit gives us our total variable costs. Subtract that to get the contribution margin, subtract the fixed costs to get the income. Or another way, if we know that we need 857 to break even and we sell 1,000 units, we're selling 143 extra units, right? Or 142, depending on how you rounded. And then you would just multiply that by the contribution margin per unit to get your profit. Okay? Anyone want any clarification here? Questions? Okay. Well, it seems like you're getting the hang of it here. We have done number 8, I believe. Yes? Yeah? Okay. I don't think we've done this one though. Problem number 4? No? Okay. So we will do that, and I'm now trying to remember to record these problems. Okay, problem number 4. So let me open the problem sets. That would be helpful, right? Chapter 3, problem 4. Okay. So this company is reducing variable costs by $2 per unit by buying some new machinery, but their fixed costs are going up by 15%. Remember how I said that's a common phenomenon? Invest in more fixed costs and your hopefully variable costs will go down. So we need to make a new contribution margin income statement. This is the old one here. And this will be the new one. Okay, so we're reducing variable cost by $2, increasing fixed cost by 15%. Is there going to be any change to our sales revenue?
No.
Right, because the number of units sold and the sales price have not changed. How about our variable costs?
Yes.
Will that change? Yeah. So you will calculate that. The old cost was 15 per unit. So you'll have to make the adjustment and figure out the new variable costs. Then you'll have to figure out the new contribution margin, subtract the new fixed cost, and then you'll get to the new net income or loss. Okay? So go ahead and work on that one for a couple minutes. Try this again. Okay, 19,500 in variable costs. So what is our new contribution margin then?
93,000.
93,000. Okay, and our new fixed cost?
46,000.
Right, how did we get that?
You get 15% of 40,000 added.
What did you say?
40,000.
Okay, or 1.15, right, would be a little easier. And then what is our total? 47,000. Okay, so that's not too hard, right? In this case, now that we've done this analysis, what do you think? Should they invest in the new machine? Not if they want their net income to go up, right? Because it's going the wrong direction. All right. Okay. Now let's move on and talk about composite units. We did talk about this a little bit on Tuesday. All right, so the idea of composite units is if a company has multiple products and you want to figure out their break-even point, well, it's easy to do with one product, but how do you do that with multiple products that each have different variable costs, each have different sales prices and sales volumes, right? Well, somebody somewhere came up with this idea to make what's called a composite unit, where you look at the ratio of how much of each product your company tends to sell. Because there are always some products that sell better than others, right? And then based on that ratio, you can create sort of a basket of products and figure out the total sales price for that basket of products, the total variable cost, and then the total contribution margin for that basket of products, which we call a composite unit. And then you can use that composite unit with the same formulas we're already used to using to figure out break even. So in this case, it literally is a basket. It's a fruit basket. And what this company sells in their fruit basket is 5 apples, 3 oranges, 2 bananas, and a pear. Okay. So every basket has that assortment of products. And if they use the same prices that they have for selling these products individually, then we can just identify the sales price for each of those items, multiply it by how many units of each product are in each basket. So 5 apples at 60 cents each is $3 of price for that particular fruit. Do the same thing, 3 oranges at $1 each, 2 bananas, 1 pear. Add up the total prices here for each individual product that's in the basket to get a total price for the whole basket. Don't worry about the cost of the basket itself. Let's just say that's minimal in this case. So in other words, they're going to charge $9.50 for this particular assortment of products, right? And they can do the same thing with the variable cost per unit, multiply it by the number of units to get a total variable cost for apples, or variable cost for oranges, etc. And we get a total variable cost for the whole basket. And then we can take the selling price minus the variable cost, and we get the contribution margin per basket. Okay. So in this case, they are selling these products literally together as one package. But even if they weren't, even if they knew that they sell 5 times as many apples as they sell pears, and 3 times as many oranges as pears, and 2 times as many bananas as pears, even if they knew that's just what they typically sold, then they can use that ratio to come up with a fictitious basket, a composite unit, and use that to then calculate break even. Okay? But sticking with this fruit basket scenario, if they rearranged and said, okay, we're going to put 5 bananas, 4 oranges, etc., by changing the quantity of each product type, is that going to change the numbers? Yeah, because each product had its own selling price and its own variable costs, right? So now if you do the math, we end up with a $4.40 contribution margin for this arrangement of fruits compared to here was $3.50, right? So if they can sell, well, let's see, the price also went up from $9.50 to $14.90. So if they think they can get away with selling that higher price, they will have a higher contribution margin. So this just introduces you to the concept. Let's take this other example here. In this case, the company has 3 products. They sell roofing material or siding, siding. I I'm dealing with a roofing issue right now, and so I have roofing on my mind. It's siding, okay. Is it really siding? Okay, I guess it is. So they have three different qualities of siding. So those are their three different products. And you see each one has its own sales price per square foot and variable cost per square foot, right? So if we didn't have this method and we had to figure out what's their break-even point, it'd be really difficult. But fortunately, we do have this method. So we know that for this company, they sell 5 units of the cheap stuff for every 3 units of the middle grade stuff and for every 2 units of the expensive stuff. They just know from history, by looking at their sales record, that is the ratio of what they tend to sell. Okay, so with that information, they can now create one composite unit. The composite unit for this company has 5 square feet of builder grade, the cheapest one, 3 square feet of architectural, 2 square feet of restoration. And they can multiply that by the individual sales price for each one to get a total sales per composite unit. And they do the same thing with variable costs. 5 square feet of builder times the variable cost for the builder grade, right? 3 square feet of architectural, 2 square feet of restoration, add it all together, and we get the variable cost per composite unit. Then if we subtract the variable cost per composite unit from the sales price per composite unit, what do you think we get?
Contribution margin.
Contribution margin per composite unit. Okay? And then we can perform our formulas to figure out break even. So we see it here, selling price per composite unit minus variable cost per composite unit is contribution margin per composite unit. Then we can take our total fixed costs, divide it by contribution per composite unit, and we know how many composite units we would need to sell to break even. Okay. And then from there, we can extrapolate how many units of builder would that be, how many units of architectural, and how many units of restoration. So, any questions? Okay. So now that we know that, in this case, it came out to 4,715 composite units. They rounded down, so let's just go with that. Okay, so if that's how many composite units we have to sell, and we know that there will be 5 square feet of builder in each one, 3 square feet of architectural, 2 square feet of restoration, we then just multiply the number of square feet for each product times the number of composite units to get the total square footage we need to sell of each product. I think of this like an accordion. You know those accordions where you have to keep going like this while you're playing it? So it's like you take all the information about the products and you bring it down to a composite unit. So you can figure out how many composite units you need. But then you need to expand it back out, back into the products and figure out, okay, how many products is that? How much revenue, how much total cost? So this tells us how many units of each product we need to sell to break even. Okay, any questions so far? Is that a question? Okay. All right. From there, we could make a contribution margin income statement, right? Because we just said we need 23,577 square feet of builder grade to break even. We could multiply that by the sales price to get the total sales revenue for that one product. Do the same thing for the other 2 products. And we see our total sales that we would need to break even. Same thing for variable costs. Taking the same square footage for each product times the variable cost per unit, add it all up to get our total variable costs. Subtract the total variable cost from the total sales, we get our contribution margin. take out the fixed costs. And what do you know? We do see we are at break even. Okay. So, oh yeah, let's go through this example. So there are only two products here, product A and product B. They sell 3 units of product A for every 1 unit of product B. Got it? 3 units of A for every 1 unit of B. The variable cost per unit is $4 for product A, $5 for product B. Selling price is $10 for A, $9 for B, and fixed costs are $220,000. Okay, what is the composite margin per composite unit? Well, we already have an answer here, $22. But how did we get that? Where did that come from? Well, that's here on the bottom. We know that for product A, it has a $10 sales price and a $4 variable cost, which means it has a $6 contribution margin per unit. And if there are 3 of them in 1 composite unit, because remember the ratio is 3 to 1, we multiply that $6 contribution margin per unit for product A times 3, and we get an $18 contribution margin, right? And for B, it has a $9 sales price minus a $5 variable cost per unit, $4 contribution margin per unit. There's only 1 in each composite unit. So that's $4. And then we add these two together, and that's where we get that $22 contribution margin per unit. Okay. Any questions on that part? I know I kind of went through it quickly. So what is the break-even point in composite units? Here it says 10,000. Where do you think that 10,000 came from?
So divide from the fixed cost to contribution margin.
Yep. Fixed costs divided by the $22 here, contribution margin per unit, equals 10,000. Okay. And how many units of product A and product B will the company sell at the break-even point? So if we need to sell 10,000 composite units, that'll be 30,000 units of A, 10,000 units of B, right? Because it's a 3 to 1 ratio. So with nice simple numbers here, it's not that.
Did you times 3, 3 times the 10, and then the
Mhm.
1 times the 10?
Exactly. The ratio is 3 to 1. So 3 units of product A times 10,000 composite units, 1 unit of product B times 10,000 composite units.
So whenever they're asking you that question, you're not going to split it between, you have to times it by.
Well, it works that way. I'm not sure how else you would do it.
In my mind, I'm thinking of like a number. So
Just do it this way.
It's whatever it is, you gotta times.
Yeah, just multiply the ratio times the composite units.
So
So,
like if it was like 3, 2, 1, then it would be 10 to the 3, 10 to the 2, and 10 to the
well, okay. So if you had 3 products and the ratio was 3 of this product, 2 of this product, and 1 of that one, and it was 10,000 composite units, then you would need 30,000 of this product, 20,000 of this product, and 10,000 of that one, right? So each product's ratio, you're going to multiply by the number of composite units. Right? Any other questions? Okay, so there's a more conceptual scenario. You're the manager of a sub shop. Your highest margin items are drinks, and they have a contribution margin of approximately 90%. That means you sell a drink for $1, there's only 10 cents of variable costs. About 90 cents is contributing towards covering your fixed costs and your profits. It's pretty good, right? It's probably pretty realistic because I think drinks are the most profitable products in a fast food sort of place. Your vegetarian sub sandwiches, though, have a 75% contribution margin. That's still pretty good, but not as good as 90%, right? So basically, your variable costs are 25% of the sales price. So how could you use a cost volume profit analysis to help you compete with another cafe? The information you have and applying the analytical techniques we've been using, how might that help you be more competitive? Here we're venturing a little bit into marketing.
Pricing, or you could either lower your pricing to be more competitive.
You could lower your pricing to be more competitive with your competitor, and maybe that'll draw more traffic in to you away from them. If you were going to do that, which price would you lower on your drinks or on your sub sandwiches?
Drinks.
Right? You could afford to take the hit there a bit on your drinks and still be pretty profitable. Right? Or maybe come up with some creative thing where you throw in a drink if they get 2 sandwiches, something like that. And then whatever idea you came up with, you could crunch the numbers using these analytical tools and see what impact that's likely to have. The one thing you don't know is when you do change a price, whether it's up or down, how does that change volume of sales, right? Because that's more of a marketing question. You can maybe look back at your historical records if you have changed prices in the past, but otherwise you might need to consult with your marketing team or a marketing research company to figure out what that impact is likely to be. All right, I think we did this one too, right? Yeah. This is where we left off in the exercise set. I think we rushed through, I rushed through this one at the end. We'll revisit this one when we get back into the exercise set. So let's go on to this new concept. Margin of safety. Do you remember the target profit concept where I told you all you really have to do is just take your target profit and add it to your fixed costs? That's kind of the same thing with margin of safety. What it means is how much are you selling above your break-even point? And that's considered your margin of safety. So if your break-even point is $100,000 of sales, and you sold $120,000 of sales, that makes sense? 120, your break-even is $100,000 of sales, and you had $120,000 of sales. That means you're $20,000 over the break-even point, and you have a $20,000 margin of safety, because you could go down $20,000 and still not be losing money. Okay, so margin of safety is how much farther in sales are you above the break-even point. And the formula here, margin of safety in dollars, it says your total budgeted or actual sales minus your break-even sales. So in that scenario I just gave you, your break-even sales is 100,000 and your actual sales is 120,000. The difference is 20,000, right? That's your margin of safety. Okay, let's see. Okay, well, let's just look through this. So this one, this is a company's break-even analysis. Okay, we see their sales price per unit, variable cost, contribution margin, and fixed costs, right? We can divide fixed costs by contribution margin per unit to get break-even in units. So does that work out? 85,000 divided by 50, 1,700. Okay. All right, well, contribution margin per unit again is 50, selling price is 90. That information we already knew. Contribution margin ratio, 55.55%. How can we calculate that contribution margin ratio? Where did that come from?
Your
Okay, so 50 divided by 90 is how we get this number here. And then you could take your fixed costs divided by contribution margin ratio, and you get your break even in dollars, right? Or the number of units times your sales price, and it should get you the same thing. Okay, so that's nothing new. Now their current sales are 2,500 units. Remember, they needed 1,700 to break even. So with 2,500 units, this is their sales revenue. Then we could subtract their break even in sales, which we had from the last screen. And we see that they're selling 72,000 more than they would need to break even. So that is their margin of safety. Now, notice here, to calculate sales at margin of safety, you take the fixed costs plus desired margin of safety dollars, divide it by your contribution margin ratio. That tells you sales at margin of safety. Does that look like another formula we've seen before?
Mhm.
It looks like the target profit, sales that are needed, right? Because in that case, it was your fixed costs plus your desired target profit divided by your contribution margin ratio. So it's really the same concept. It's just we're saying not this is a target profit, but this is how much safety we have. And it's just a different way of looking at the same thing. So that's nothing new. However, if we want to figure out what's called the margin of safety percentage, that is a new concept, a new formula. Here we're taking the margin of safety dollars, dividing it by the actual dollars or budgeted dollars of sales. And that gives us what's called margin of safety percentage. So we do have a problem that's going to involve that. So we'll walk through an example of that in the problem set. But just keep in mind that's a new formula there. All right, anybody have any questions? See how we're doing time-wise. Okay, pretty well. All right, well, I guess is this the one? Yeah, let's do this one. Exercise 14. Okay, let me explain this one. Okay. So here's our data. This is actually repeated down here in this table. We really don't need that image up there. The question is, what is the company's target margin of safety in units and dollars if they required a $14,000 margin of safety? So a lot of these pieces of information are not changed. Their units sold is still 400. Their sales price per unit is still 550. That variable cost stays the same. Contribution margin per unit stays the same. Fixed cost stays the same. So I think I can just copy and paste all that in there. Oh, no, here we need, okay, not that one. Okay, that's where we need to change things up. So here we need to take our fixed costs and add our margin of safety. So what were the fixed costs? And what's the margin of safety that they have set for themselves?
14.
Okay, so we're just gonna add those together. Fixed costs plus the margin of safety. We get 17,500. So now, how many units would they need to sell in order to reach that margin of safety? How can we figure that out? Divide? So what are we going to divide by what? Yes, we'll take the fixed costs, well, almost, the fixed cost plus the margin of safety and divide it by the contribution margin per unit. And that will tell us how many units we need to reach that margin of safety. And that comes out to 100 units, right? Okay. Now the contribution margin ratio hasn't changed. I'll copy that down. How can we figure out our target margin of safety in sales dollars? Remember how we saw it here? Fixed cost plus your margin of safety divided by your contribution margin ratio. So here we have fixed cost plus margin of safety. We'll divide it by our contribution margin ratio. And let's see what we get. So that's 17,500 divided by 0.3182. And we can round that off to $55,000 of sales. What would be another way we could calculate that? Exactly. The 100 units we need to reach that margin of safety times the sales price. That would also come out to 55,000. We wouldn't even have to round in that situation. So as you see, it's the same formulas, right? For break even.
Instead of we gonna have one like this
I think maybe. Let's take a look.
for the rounding, you know, what is
Well, let's see. Let's see if we have one for rounding. Usually, if you round off two places after the decimal point, that's the most precise.
Okay.
And there's a buffer in Canvas, anyways. But let's see if you even have one. So these, so not there. I think the only one that deals with margin of safety we're going to go through together. Yeah. Yeah, just the last problem deals with margin of safety, and we will go through that together. Okay. So we have solved that exercise. Those are the answers. Any questions? All right, let's see where we're at here. We have a couple more slides. That's what we just did. Operating leverage. Okay. So what is leverage? If you think of like physics, what is leverage? Did you learn how Like if you've got a rock that's too big to move, but you take a stick with another rock under it, and then it gives you more leverage to lift that bigger rock. You know what I'm talking about? Okay. Well, in finance, you can have leverage as well. It's using some attribute that you have in order to do something you couldn't otherwise do. So when we're talking about operating leverage, it's basically using high fixed costs and low variable costs in order to be more profitable. I think I mentioned this earlier that often companies will do that. They'll invest in things that require higher fixed costs, but they do that in order to lower their variable costs. So when you do that, it's risky because what if you don't sell enough to cover those higher fixed costs? Then you're losing money. But the reason they do it is if they do cover those higher fixed costs, because their variable costs are lower, they're going to be that much more profitable for everything they sell past the break-even point. That's called operating leverage. And yeah, that's exactly what I was just saying. I don't need to repeat that. Okay, so here's an example. This company has fixed costs of $25,000, right? We see $100,000 of sales revenue, $40,000 in variable costs based on $4 per unit. See their contribution margin minus their fixed costs equals their net income. What if they were to shift their fixed costs by $10,000? So here we have the fixed costs going down by $10,000 and variable costs going up by $10,000. And over here, we have fixed costs going up by $10,000 and variable costs going down. So in each case, they shifted one way or they shifted the other way. And if you look at the net income, you see there is no impact. You end up with the same net income. So that shift does not appear to have made a difference. But it actually will if the company's sales volume changes. If their sales increase, the company with the higher fixed costs is going to benefit more. And if sales decrease, the company with the higher fixed costs is going to get hurt more. So it's risky. If you can cover those fixed costs, it's going to be more rewarding. Okay? So let's see how it actually works here. Those last two examples where they shifted between variable and fixed costs, right? They shifted one way over here where fixed costs went down and another way here where fixed costs went up, right? So what if there was a change in sales, a 10% change in sales? Okay, so they've sold 11,000 units at $10 each. It's the same thing in both scenarios. Now variable costs here, you're selling 10% more units, you're gonna have 10% more variable costs, right? Because you're producing more units. So you see their variable costs have gone up by 10%. Here, their variable costs go up by 10% as well, but that's an increase of only 3,000 here, where it was an increase of 5,000 over here. You see already the contribution margins are different. Now you take out the fixed costs, and this company came out $5,000 more profitable. The one with the higher fixed cost benefited more from that increase of sales, even though they both have the same sales revenue. And it's that shift to more fixed costs that gave them more operating leverage. Okay, any questions?
Is there any specific difference between the operating leverage and like the economies of scale? Because this method is kind of the same, almost the same concept.
Well, so economies of scale. arise from a couple things. It could be higher fixed costs that give you economies of scale and lower variable costs. But it could also be that because you're buying in large volumes, your costs go down as well. So there's definitely a relationship. But
So a slight difference.
yeah, I would say economies of scale can be due to multiple factors that could include operating leverage.
Okay.
And that's an economics term, so you don't have to use economies of scale in this class. In case anybody was confused. So let's see. So here we have decreased variable costs. Yeah, this was the one I was mentioning where they put in self-checkout stations. So there's a fixed cost involved in doing that because you got the cost of the machines, and the software, but then less labor costs, right? Because you don't need as many cashiers. So in this particular example, you see sales stay the same. Variable costs have gone down with the new self-checkout, which means contribution margin goes up. But the fixed costs are higher, right? Because they had to invest in that machinery. And in this case, they still came out ahead. So it would make sense for the company to do that from a financial perspective. Now, it also includes here, what is the percentage of increase in income? 35%. Does anybody know how that 35% would be calculated? How did you figure out what percentage their income increased? Yeah, dividing is part of it.
You would subtract the highest from the lowest and then divide that by whatever the lowest was.
Okay, yeah. So if you take the difference in operating income, we see it went from 6250 to 8437, right? You would take that difference because that is the dollar amount of an increase. And then you would divide that difference by the original income and see it rose 35%. And we will be doing that with the last problem when we get to it. Okay, so operating leverage. I've explained to you the concept. All right, let's look at it mathematically. So, okay, so the degree of operating leverage is equal to your contribution margin divided by your net operating income. That's how we turn this into a mathematical number. I guess that's redundant, right? A number, how we turn it into a number. So here are some examples. We've got company A and company B. We see the formula here to calculate your operating leverage. You take your contribution margin, divide it by your net income, and it gives you your operating leverage. Higher is better. So an operating leverage of 2.47 is better than 1.74 because you have more operating leverage. So again, as long as sales are increasing, you're going to benefit more than the other company. If you have the higher operating leverage. In this case, both companies have a net income of $85,000, right? So why do they have different operating leverages if they have the same net income?
I think costs are a lot less than
Well, it's really the contribution margin, right? Because that's how we get the operating leverage. It's the contribution margin divided by the net income. So even though the net income is the same, it's the difference in contribution margin that gives the different operating leverage. Okay. Now, here's kind of a neat thing. If you take that degree of operating leverage, like these numbers here, multiply them by the percentage change in sales, like sales went up 10% or 20%, you will see what impact there is on operating income. It will tell you the percentage change in operating income. So let's see if we can, we can't apply it here, but we will be able to apply that with the last problem. Oh, can we apply it here? Oh, here we go. Yeah, here we can do it. We can do it. Okay, so there's a 20% decrease in sales. Both companies experienced that 20% decrease. These are the same companies we're just looking at. So company A went from $250,000 down to $200,000, 20% decrease. Now, if you take that 20% decrease and multiply it by their old operating leverage, so 1.74 times the 20% decrease, it will equal a 34.8% change in net income. And same thing with the other company. They had a 2.47 operating leverage. If you multiply that by the 20% decrease in sales, you get a 49.4% decrease in income. Okay. So based on that knowledge, there's a multiple choice question for you. This company has a contribution margin of 58,560, net income of 24,400. Their volume is expected to increase by 5%. What are the degree of operating leverage and the expected percent change in income? Would it be A, B, C, or D? How can we figure that out? Divide, I'm sorry, say it one more time. Okay, did you try that? To see what you get? Okay. Wait, you got 2.4? Okay, so you divided contribution margin by net income and you got 2.4.
Yeah.
So that might be the right answer right there. Right, that is our operating leverage. And then if we multiply 2.4 by the 5% change in sales, what does that give us? 12? Okay, so C is the right answer. Good job. All right, another question. Oh, yes. So we work for a large manufacturing firm. Our sales are above the break-even point, well above the break-even point. Most of our costs are fixed costs. However, the outlook for the industry is not so good. Maybe we're making something that's becoming obsolete. People are not buying it anymore. So that's a problem, right? What could we do to reduce our fixed costs so that we will decrease our risk and not have so much operating leverage? If we're expecting sales to go down, we know that having high fixed costs is a bad thing, right? So how can we then bring our fixed costs down and shift them to some variable costs, considering that we're a manufacturing company?
You could either have another manufacturer sell your parts.
Okay.
Like you could look at if it makes sense for you to keep manufacturers parts. Or you could try to change salary. Does changing salary employees to hourly change fixed to variable?
Yep. Okay, those are both good suggestions. So one would be outsource some of our production. And if we do that, then as our production needs are up, those costs are going to go up. As the production needs are down, those costs go down because we're paying another company, right? And they can scale up and scale down. And by doing that, if we are doing less production ourselves, maybe we can get rid of some equipment, maybe we can sell some of our factory space or something and reduce our fixed costs. Your other suggestion was to shift some of our fixed salaries to hourly. Maybe get rid of some of our salaried employees, like some of the management. And maybe bring in some temps or some hourly workers where if we have to let them go, or if we have to tell them not to work as many hours, we can vary, right, the labor costs. Yeah, those are both good suggestions. Okay. Any other thoughts? I think those are the main things. Get rid of fixed costs like salaries, rent, insurance, equipment leases. The more we can get rid of those and shift them to other things that are variable costs, the safer we will be. Okay. So what have we learned? We know all about the contribution margin, right? We're best friends now with the contribution margin. We know it has a per unit version, it has a ratio version, and a total contribution margin version, right? We know how to do break-even analysis and figure out break-even in units or break-even in sales revenue or dollars. We can apply a CVP analysis to determine the sensitivity of our profits to changes in variable and fixed costs, as well as changes in volume and changes in price. And we know we can use composite units when we're looking at multiple products and trying to analyze changes and break even. We know about margin of safety. That's the amount we have sold above our break-even point. And we know about operating leverage, the degree to which our fixed costs outweigh our variable costs, which gives us more potential profit, but more potential risk, right? So that is chapter 3. Looks like we've got some time before the break, about 8 minutes. What questions, Jahara?
For margin of safety, would that also be considered like a profit as well?
Well, it would be profit because it's your sales above your break-even point, but that margin of safety is not going to be equal to your profit because you do have to take out your variable costs from your sales, right? And then any other costs, operating costs too.
Yeah, okay.
Good question. Okay.